Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. This morning we are starting with a ceasefire. That's the word of the day, I guess. I'm Prashant. With me, my colleagues Surabhi and Nigel. Morning.
Hi. Good morning, folks. So much drama. Who needs movies these days or any kind of a potboiler or a thriller, right?
I disagree.
And that's actually true. Movies make the heart fonder.
But
and then we wake up this morning to, again, the declaration that Mr. Trump has saved the world yet again.
That's what he claims. So that's important. But I think the worst of this conflict is behind now, right? Going by all the indications, all the commentary that you got. Let's hope markets as well move on.
Absolutely, and that's the first line. The graphics will come up on your screen. The worst is over. Yeah. And actually, we were saying this yesterday that if Iran's response is weak, oil has got potential to fall a lot, and I think it has fallen a lot. I mean, 15% basically from yesterday's high. So let's just take it from the top in terms of what you need to know as we start this new session. Worst of the conflict is behind us. At least that is what it looks like. Trump has announced a ceasefire. I'm not going to go into details, but basically there are two tweets which we can pull up later. But basically he said that there's a ceasefire between Iran and Israel. It looks like, the ceasefire is for sort of 12 hours. I mean, it's a little complicated, but 12 hours. But the point is, a ceasefire, once it is announced, is easier to continue rather than announce in the first place. So, and that's the reason, that's the way I would look at it. There are lots of reports which say that Iran has said, well, we won't agree to a ceasefire. But don't look at what they are saying. Look at what they're doing. What they're doing is, oil, by the way, of course, is down about 15%. Yesterday's high was about $80 or so. It's down to 69, 67 earlier. So down quite a bit. As I said, look at what they're doing. Iran's retaliatory strike was weak. It was almost symbolic. It looked scripted. It was intentionally weak as well. So what did they hit? They hit, airbase in Qatar. They hit Iraq as well. I mean, U.S. assets in Iraq. But Associated Press reports that, for example, in the base in Qatar, there were no aircraft. There were some 46 aircrafts on the 5th of this month. They were all moved out. Qatar has confirmed that there have been no casualties, no real damage, etc. So, and this is what I was saying yesterday as well, that if the strikes are very targeted, that's the off-ramp which Iran is looking for. It's like, they can't lose face with their population. They've got to hit back, but it's targeted, it's symbolic. We've seen this earlier as well. That's the off-ramp. That's the off-ramp to de-escalation. And that's perhaps the way the market is looking at it as well. If it had been sort of, striking bases around the region in Middle East and US, has lots of them, that would have been sort of completely different. Then all bets would have been off, but that is not what has happened. It's targeted. It's meant to show that, well, this is happening, etc., etc. Now, to the point that many are making that, well, there are still missiles flying and there are still Iran has launched missiles. An hour back, I saw some news reports, etc. I would look at all of this as winding down in terms of the conflict, the worst of the conflict that we've seen before some semblance of peace and pre-escalation kind of returns. That scenario returns back to the region. We'll see. But expect rhetoric, commentary, etc. to remain very high, both from Iran and from Israel as well, over the next 10, 12 hours or so. By the way, just to go back to the market action, last night S&P was up 0.9%, NASDAQ was up about 1% gains last night. This morning, if you look at what the S&P futures are doing in Asia, they're up another 0.5% or so the last I checked. Dollar index is down about 0.5% as well from yesterday's high. So you've got this reaction coming through. We look at US Treasury futures. But the point is, Treasury markets, neither as we've said, dollar or bonds, US bonds, sovereign bonds, did not really react were not bid in any aggressive way in response to the attacks in the first place. So reactions in that sense are kind of mild. The big, cleanest way to kind of, look at what the market is making of it is oil. And the oil market is telling you that most likely the worst perhaps is behind. Later tonight, you've got the Fed Chair Powell's testimony before the House Financial Services Committee. And he will take questions from the House Services Committee. And this will be interesting because most likely he will be asked about his boss, President Trump's exhortation to him to lower rates and why he's not doing it. And it'll be interesting to hear his responses in that sense. Now, we don't expect to hear anything very, very new or earth-shattering or market-moving, but should be interesting nevertheless. I'll just tie in the levels, etc. So today, of course, all the oil sensitives, oil marketing companies on one side, which is on the way up, oil producing companies on the other side, and of course the other regular oil sensitive names, etc., should be in focus. We'll talk more about that. But for the Nifty, for the indices, right? For the Nifty, 25,222 is the resistance level. It's the recent high, the swing high. The support comes in at 24,824. That is the hourly low. It's the immediate support that we are going to work with. For the Nifty Bank, the resistance stands at 56,328. And the support stands at 55,600. Which is the swing low recently. So I think these are levels that you can work with. GIFT Nifty should give you a sense of how we are likely to open. Oh boy, 300 points nearly on the GIFT Nifty. So, zip up and zoom higher. The market reaction is very, very clear in that sense, both in terms of oil and, of course, what's coming through as far as the GIFT Nifty is concerned as well. Surabhi.
Absolutely. I think today is the day that bulls get that flip up they needed to get right back at the top of the trading range. And let's see if this time there can be a decisive breakout on the way up. By the way, you guys remember there's the NATO summit as well, which kicks off today. And last we heard was that Mr. Donald Trump said that he will attend. There was a lot of flip-flop whether he's coming, not coming. Last we heard he's going to be in Netherlands for the summit. And now perhaps he'll want to flaunt what he'll call another win in his crown, getting the ceasefire going. So for what it's worth, I wanted to put up the quote first, the abridged version of that tweet where he declared that there's a ceasefire and that the Middle East has been saved all over again. He says that it's been fully agreed by and between Israel and Iran that there will be a complete and total ceasefire for 12 hours, at which point the war will be considered ended. Officially, Iran will start the ceasefire, and upon the 12th hour, Israel will start the ceasefire, and upon the 24th hour, an official end to the 12-day war will be saluted by the world. That's what he's calling it. He's calling it the 12-day war. Remember, there was a 6-day war in the region many, many decades ago. During each ceasefire, the other side will remain peaceful and respectful on the assumption that everything works as it should, which it will. I would like to congratulate both countries, Israel and Iran, on having stamina, courage, and intelligence to end what should be called the 12-day war. Then, of course, he goes on to take credit, but this is the operative part of that post that declared that this is indeed perhaps winding down. Now, markets had been sort of reacting in that way. It was quite uncanny to see those missiles fly over Doha last night, and the markets kept rallying and oil kept falling. Oil was down about 7% to 6% last night itself. It's fallen a little more this morning. And Asian markets are up and about. Let's get the Hang Seng, for instance, up for you. That's oil. So we're talking about a fall of $8 to $9 since Friday, since we were trading and we closed off on Friday. So almost a $10 decline. Look at the Hang Seng, a near 2% rally on that market. Most markets are up 1%, if not more. And that explains the exuberance on the implied open as well, that we saw about 300 points of a pop coming through. Now, the sense that at least I get looking at a lot of the cues around is that as this settles, the focus is going to go back to trade, which is a little more closer to the market's heart. And there, we need to keep on board that when it comes to the bilateral agreement between India and the US, the headlines, and they've been sort of, been buried deep within, but they're not very comforting. It seems to be a bit of a sticky patch on those negotiations between India and US. And the sticky patch is, agricultural products. US wants greater and complete access for all its agricultural products. India is not, very comfortable with that. And the second is GM crops. Again, US wants, complete entry. And that's something that's a bit of a sticky point for us. So let's watch for this. The July 9 deadline is also approaching. So this is a bit of a negative headline. But anyway, we'll cross that bridge gradually. Coming back to the flows in the market picture, like I said today, in all probability, we'll be right back at the top of the trading range, which is 25,200. Flows yesterday were negative, about 1,900 crores of selling from FIIs. Domestic institutions were strong buyers. We'll see how this plays out. But the momentum is on the upside today. Just a couple of stocks on your radar because they will be excluded from the F&O market from the 29th of August, as per the usual revisions that the exchanges carry out. They're on your screens: AB Fashion, CESC, Adani, Total Gas, IRB, Poonawalla, FinCorp. Just some names to keep on your radar, but promises to be a solid green start. Nigel.
Well, that's right. The gift, if you're suggesting we're going to have a solid green start, and you'll be disappointed by the end of the day that if you don't go home with 200, 250 points on the Nifty itself. And the Troika overnight actually is favoring a big move in today's trading session because crude oil prices, that's the one that we track very, very closely. That's fallen sharply. And you have some kind of cooling off, both on the dollar index as well as on the US bond yield. So all the three factors are in favor, pointing to a solid start to trade. Yesterday, there were a couple of positives, though. The Nifty Bank, both of them managed to conquer the 20 DMA on a closing basis. And also the Nifty futures moved into premium in comparison to a flattish number. So those were positives. But the biggest positive really was the breadth of the market. And you saw all through the trading session, gradually you saw that advancing line from starting at around 400 stocks that were advancing, ended close at around 1,250 stocks that were advancing. That is a clear positive telling you that the domestic players and the retail audience out here, as well as large HNIs, as well as the domestic institutions, they were allocating money. And that explains why the broader markets did pretty well in trade yesterday. The other factors, the India VIX, it's still at very, very low levels. Keep in mind, we have geopolitical issues that have been playing out. There's a lot of other factors as well at play at the global screen. And yet the India VIX is sub 15. That's telling you that, in fact, there is a fair bit of bullishness and optimism about the markets chugging along even from here on. What did the FIs do? Well, they added some short positions. Not a bad thing. They added some short positions. They unwound some longs. And they continue to remain net short with close to around 77% of their positions on the short side. You look at it in absolute terms as well. The clients, well, their long positioning has moved to around 68,000 contracts, while you have the FIs that are net short. I'll tell you what, this sort of a combination is actually perfect from a bullish perspective because an FI being net short with more than 1 lakh contracts, that's normally good times. And now you have a good start, could force them to cover some of their shorts. The options data comes up for you on the screen, and the call writers are getting very, very confident. Even in yesterday's trading session, between the 24,900 call as well as the 25,000 call, more than 40 lakh shares were added there. So there was aggressive call writing that we saw. But on the put side as well, there was 20 lakh shares added at around the 24,900 odd mark. So the levels come up for you on the screen. We're going to be starting above, in all probability, above the 25,150. But going by the options data, it seems the bears were playing for this level to hold out. Remember, this is closer to the high that we saw on Friday as well, of around 25,136. So I'll keep an eye on this level. On a closing basis, you want to end above that. On the downside, the support comes in at around 24,800. Yesterday's low as well is in this vicinity, so we'll keep an eye on that. The Nifty Bank, it's been in that 800, 850 point range. Yesterday, it conquered the 20 DMA. Today, you'll want it to get past that 56,350, 56,400 odd mark. That's going to be the important factor today. Since crude oil prices have cooled off, the OMCs will be in focus, and I'll keep an eye out on all of them. Yesterday, they saw some buying from the lows of the day, but HPCL, BPCL, and IOC could very well be the stocks of the day.
Okay, definitely watching out for them. Thanks for that, Nigel. Well, let's get you the equity call of the morning. Vikas Jain of CLSA says the past 12 months have seen Indian equity underperform emerging markets, world equity, Indian government bonds, gold, silver, and even bank fixed deposits. He says, despite this underperformance, Indian equity multiples remain elevated, that is, due to big cuts in Nifty EPS estimates. He says a combination of poor 12-month performance and elevated multiples, along with a huge lineup of capital raising and IPOs, may pressure equity inflows. They keep their near-term return expectations muted. He says sector rotation may hold the key, and that is CLSA. They are expecting triggers in the coming months to be more likely from global markets and recommend IT as an interesting relative bet. He says their India-focused portfolio is also overweight on staples, real estate, energy, utilities, and banks. Slightly cautious on the Indian market.
All right. Well, that's Vikas of CLSA with his thoughts. Let's welcome in Ed Clissold, is Chief US Strategist at Ned Davis Research. Ed, good to have you with us here. Thank you very much for joining us here on CNBC TV 18. Oil's down some 15%, Ed, from that $80 high that we saw. It's a clear indication that the market's saying, well, this is done for now. Even as there are reports coming in that there are some strikes which are being conducted and missiles are flying, etc. Would you see these reports as sort of, the last chapter of this short-lived conflict in that sense? Ed, how would you view it?
It certainly seems to be how most of the political leaders are trying to get to. In the fog of war, anything can happen. But it seems like Iran has been weakened to the point where they are looking for a way for an exit. And Trump most likely never really wanted to get into this, but if he did, he wanted to be a quick U.S. involvement, which is what has happened so far. Keep in mind, there is a very big part of Trump's base that is very much against intervening globally. And so Trump would be looking for an exit as well. So the more likely scenario from here is that they come to some sort of agreement on a ceasefire. Of course, with a huge caveat is that when missiles are flying, anything can happen.
Ned, hi, good to have you on. But the market all this while has been interpreting this as a limited conflict, one that will not have much impact on the supply of oil. So far, it's got it right. Would you expect de-escalation from here on?
Look at it in a slightly bigger perspective. And what happened last week? Look, the S&P 500 was down 4 out of 5 days by about 1.5%. The Dow Jones Industrial was down almost 2%. So the initial reaction to the Israeli attacks was one that was somewhat negative. Now, we've studied almost 60 different crisis events. These are U.S.-centric crisis events, but over 60 of them going back to 1907. And there's a pretty consistent pattern where there's an initial knee-jerk reaction, but in short order, the market tends to recover. And so that seems to be what's going on here. So by the time the U.S. got involved, well, it only was a week later, but in terms of an investor perspective, there's already time to digest it, maybe have the overreaction. Since the U.S. was signaling the whole time they wanted it to be a limited action, that it looks like if the U.S. achieves its objective of crippling the Iranian nuclear capabilities, then it seems like the market is probably on the right path to viewing this as a limited conflict.
Hi, Ed. Good morning. Good to see you, Ben. I've been following you on X, and you've been making that point, right? Post a conflict, you normally see equity markets that do well, but this time around, we consolidated and we didn't have any kind of big knee-jerk reaction on the downside. That said, the US markets as well have their fair share of challenges, right? The tariff situation still remains very, very fluid. Earnings growth may not be as much as expected. In that sort of a backdrop, what's the outlook with regard to US equities, which is the mother market? And then we'll talk about other equity markets as well.
So coming into 2025, we had some concerns. One was that U.S. economic growth was likely to slow. Secondly, earnings growth, particularly from the Mag 7 stocks, was likely to slow quite a bit. And then thirdly, inflation was most likely to increase somewhat, partly due to the housing market in the U.S. being quite inelastic and prices remaining elevated. And then you throw on tariffs on top of it, and it means each of those three are actually slightly worse than they were before. So economic growth a little bit lower, inflation certainly a little bit higher, if not quite a bit higher, and earnings growth outside of the Mag 7 is probably going to be lower than what expectations were earlier in the year. And so that leaves us with a path forward without a major decline, but to think we're going to get huge gains from here is probably a little bit wishful thinking. So it's going to be kind of a muddling through for the next several months. We have a year-end target of 6350 on the S&P, but I think that the more important thing to think is to consider is a slight overweight to stocks versus bonds, and maybe a choppy move higher for U.S. stocks.
Ed, I guess, we'll soon go back to talking trade deals and where all those negotiations stand as we get closer to July 9. And the sense that we're getting from some analysts is that eventually, I think, on a blended basis, U.S. tariffs could be anything between 10 to 15%. Is that in the price already, and what that'll do to inflation? Or could that, impact market sentiment negatively?
I think markets have gotten a little complacent when it comes to tariffs. The idea being that the 90-day pause is really Trump signaling that he is going to capitulate and the worst case scenario won't come to fruition, or that the so-called taco trade, Trump always chickens out. I'll be a little bit nicer to the president and say that the market usually doesn't price in the same news the same way a second time. So if there is another wave of consternation around the July 9th 90-day window ending, the market probably won't react quite as negatively. But what we looked at S&P 500 profit margins and just made some back of the envelope estimates that if you look at tariff revenue for the last couple of months, extrapolate that out through the end of the year, and S&P companies absorbed all of that cost, that would knock about 100 basis points or 1 percentage point off of S&P 500 profit margins. Now, that's kind of worst case scenario. Not all S&P companies are gonna absorb all of it. They'll pass some of it on to consumers. There'll be companies outside the S&P that'll absorb it, because keep in mind that those largest companies are the ones that can probably navigate this better, have the political clout to go to the administration and try to find some loopholes. And so we were thinking maybe it's about half that, about 50 basis point hit to profit margins, which could knock S&P 500 profit growth to around 5%. So there's some doubt. Now, consensus is still around 10%. So there's some more downward revisions from here. And then in terms of inflation, the more that's passed on to consumers is more that's going to show up in the inflation data. And the U.S. CPI could move towards 3%. By the end of the year. If it's a slow move higher from around 2.4% right now, probably not enough to disrupt the markets. If it's a shocking move higher over a couple of months, then it probably would be a bigger concern. But there seems to be a path forward where a little bit weaker economic growth, a little bit slower earnings growth, a little bit higher inflation is probably how this is going to play out.
All right, Ed, we'll leave it there. Thank you very much for joining us. Good speaking with you here on CNBC-TV18. Well, I think we'll quickly run you through what's lined up here on the program over the next two and a half hours. So we'll have the CEO of Latent View Analytics joining us to decode their outlook for the year ahead. So Rajan Sethuraman will do that for us in a bit. IT is in focus with Sandeep Agarwal, IT stocks that is. That's coming up at 9 o'clock. 9:20, Shreyash Devalkar of Axis Mutual Fund will be speaking to us about the road ahead for equities. 9:30, Narayana Health, stocks been on fire. Changing phase of healthcare, diagnostic space, Amazon's entry, does it change anything? The conversation, interesting one. Kalpatru Management with us in the studios at 9:40. So they raised money. 9:50, Nikhil Bhandari of Goldman Sachs will be with us on their what they think are the top investment themes that you should focus on. And towards the end of the program, Karan Thorani of Elara Capital and Raj Nayak of the House of Chia Networks will discuss the rise of global short drama market in India.
Well, time to slip into a short break, but we've got a lot of stock-specific news to track for you in our special Top 10 segment. I'll run you through the list for now. SBI Card, Metro Brands, Kochi Shipyard, paint companies. We'll have OMCs. Both of them will be on focus on the back of positive news flow. KPIT Technologies, Dixon Tech, Marathon NextGen, ONGC and Oil India. All of them will be reacting to negative news flow. Take that break, come back. We'll get into further detail on all of these names.
Welcome back. It's a green morning across Asia. Let's pull up those markets once again and get the implied open back up, because markets are up anywhere between 1% and 2%, as you can see there. And that's what we're getting, immediate surge, 250 points plus at the open. So while the overall backdrop is, in favor of the bulls, let's see what about individual stocks and the ones that we need to, of course, keep on our radar. As usual, We have our team standing by with the CNBC-TV18 list of top stocks to watch. Vamakshi, let me come to you. SBI Card, what's new?
Well, SBI Cards has reported its data for the month of May, and the May spend market share for the company has gone up from 16% last month to 17.1% this time around. The card spending too has grown at a much faster pace as compared to the rest of the industry. It's up almost 10.1%. Spending has risen 23%. This has come in at a much faster pace when we compare it to the month of April, and has grown in much faster than the industry growth of 15%. As far as number of credit cards are concerned, the market share here is flat month-on-month basis at 19%, but however it has improved by 50 basis points on a year-on-year basis. The total credit cards in force also saw an uptick of almost 10%. This is much faster as compared to the industry, which saw an uptick of almost 10%. So therefore, just to sum it up, the company has reported growth above the industry levels. They've also managed to gain market share in terms of market spends. So therefore, expecting a green-looking screen for SBI Cards.
Okay, all right. Thanks a lot for that, Vamakshi. Keep in mind, that's a stock, actually, if you look at it in the last 3 years or so, is still around the same price that it was 3 years back. But clearly, this update is quite positive. Well, let's hop across to Vinny. She's here to tell us about some more stocks in news. Vinny?
Hi, good morning. So firstly, starting with KPIT Tech, they came out with their business update as well. The company is highlighting that the business environment is still quite uncertain. Geopolitical tensions continue. So overall, a bit of a concern coming in on the business environment front. Deal pipeline, they said, is strong, but the conversions are slower than expected. Demand trends in Europe are good, while in the US and Asia, they aren't as good as one was anticipating, and a bit uncertain on those lines and in those regions. Ramp-ups, they're seeing that ramp-ups for wins are progressing at a slower pace. So that again turns out to be a concern for the company. And one-time gains that they saw in Q4 FY25, that will not be there in Q1 FY26. So a bit of a subduedness in terms of, or a muted performance in terms of profitability is what one could watch out for. Other income also, they're expecting that also to be a bit lower this time, given that there was some bit of a sudden change in terms of forex rates. So that is something that will impact the other income of the company. So we're expecting a bit of a red on screen for KPIT Tech. Metro Brands, Clarks has announced a strategic partnership with the company. Now, obviously, this is mainly going to be for exclusive rights as well as digital partnership for India and some of these neighboring countries that we have, like Bangladesh, Bhutan, Nepal, Maldives, as well as Sri Lanka. So green is what we could expect here. Cochin Shipyard, one of its arm, has won an order which is in the range of around 100 to 250 crore rupees. And this is to construct 2 luxury river cruise vessels. So that is why Cochin Shipyard, green is what one could watch out for. Dixon Tech is the last one that I'm keeping an eye out on. We're seeing the promoter here, that is Sunil Vachani, has sold 16.7 lakh shares. That's approximately 2.77% stake in the company. And this was in yesterday's trading session, and this came out in the bulk deal data yesterday. Sunil Vachani held around 5.34% stake as on March 2025. So half the stake is what he's sold. And this is mostly bought in, and this is bought by Motilal Oswal Mutual Funds, which is 14 lakh shares is what they've bought. That's 2.4% stake. So maybe we could see a recovery coming in the stock, but maybe a dip is what we could watch out for in the starting.
All right. Thanks very much, Vinny, for that. So a bunch of stocks there in focus. Let's talk about Marathon Next Gen. Vivek is here with the news around it. I think that stock found a mention on Nimesh D Street Chatter list yesterday as well.
That's right. Our colleague...
Vivek, take us through it.
That's right. Our colleague, Nimesh mentioned it in his D Street Chatter that there could be a large fundraise in the offing, and along expected lines, the company last evening has launched a QIP to raise close to 900 crore. The indicative issue price for this particular fundraise is at 555 rupees a share, indicating a 12% discount to yesterday's close. The equity dilution is quite significant at over 31.5% of the total outstanding equity. What is the company looking to utilize the funds towards? Number one, subsidiary investment close to 160 crore, debt repayment of close to 340 crore, land acquisition as well as land rights at close to 300 crore, and the remainder will be used for general corporate purposes. Now, one thing that is important to note as far as Marathon is concerned, at the end of FY25, the company had announced that they would be going ahead and merging certain unlisted and private entities of the promoter group into the company's fold itself, and this particular QIP will most likely help the promoters meet the minimum public shareholding norms post the fundraise.
Okay, all right, got it. So Marathon Next Gen on our radar as well. Vivek, thank you for that. Let's talk about the big drop in crude oil prices. We have Manisha joining in. Manisha, morning. I was just telling Nigel and Prashant that it was a little surreal for me to watch those missiles fly over Qatar and simultaneously the price of oil was falling every minute. You take it away. What a night.
Oh, absolutely. What a weekend and what a night. Yes, after the weekend, we saw the crude oil prices jump up by 5.5% in the Asian markets yesterday. And by the time the day was getting done, it was 11% on the lower side. What we have done overnight is close the crude oil prices down between 7 to 8%. Asia started nearly 3 to 4% on the lower side, but there seems to be some opportunity buying after that very, very sharp decline yesterday. But yes, as you mentioned, Iran's retaliatory strike on U.S. base in Qatar caused no casualties. It perhaps was a show of power. Apart from that, the oil market has avoided its worst-case scenario in which Iran chokes off energy exports from the Persian Gulf, from the Strait of Hormuz, that is. So that also is ruled out right now. And the crude oil prices with this correction are now trading at levels before the Iran-Israel war broke out. And the market's now clearly looking at that ceasefire conversation, if any of those statements coming in right now. And with that, we are now focusing back on the higher supplies for this year and an expectation that you could be looking at crude prices going further down. What the street will watch out now is the Powell testimony tonight, the July 9th tariff deadline, the big, beautiful U.S. tax bill passage. With the war taking kind of a sideline, the focus comes back on more macros.
Yeah, but it's not going to be dull at all, given the other events that you described, right, including the big, beautiful bill. We almost forgot about that. Thank you very much, Manisha, for that. Let's quickly recap our list of stocks to watch today. The ones that have positive news flow are SBI Card, Metro Brands, Cochin Shipyard, Payne stocks, OMCs. The stocks which have negative news flow around them would be KPI Tech because of its mid-quarter warning, Dixon Tech, Marathon NextGen, and ONGC, as well as Oil India. Take a quick break. We'll come back on the other side. We'll have Amnish Agarwal join in for some fundamental stock talk.
Welcome back. As promised, let's get chatting with the management of Latent View Analytics in their, which is the first corporate on the show. The global data analytics business is projected to grow $403 billion by 2032 from around $65 billion right now. To discuss this, as well as what's the big opportunity in the AI space, we're joined by Mr. Rajan Sethuraman, the CEO at Latent View. Hi, Mr. Rajan. Good morning and good to see you. Well, first, let's just get a couple of basics out of the way. Accenture, they have flagged some caution, but you were guiding for around 18 to 19% revenue growth with margins at around 23% or thereabouts for FY26. Right. That still holds?
That still holds, yeah. No change to that. In fact, I just got back from a trip to the US, and we have confidence based on the conversations that are currently underway.
All right. So that's good news then. You're sticking to that guidance that you'd given us earlier. Post this trip in the United States, is there a chance that you can outbeat this high teens revenue growth that you were targeting?
I would say it's still early days. I mean, I was hearing a great amount of interest and euphoria about everything AI, Gen AI, and agentic AI. And many of the people that I talked to, both with big companies as well as smaller startups and services firms, they indicated that there is a tremendous amount of work that needs to be done in order to capitalize on all these opportunities for enterprises and for services firms like us. But given the macroeconomic scenario at this point in time, we still caution in terms of big deals coming through. So I would want to wait for some more time right before I'm able to comment on that.
Got it. All right. Now, Gen AI is high single digits as a percentage of your revenue, but you have guided that you're going to be doubling this. What kind of interactions are you having with the clientele? And what kind of response have you got? And how confident are you that from around 8-9%, it goes to, say, 16-17% in the coming year? And in fact, post that, takes even a larger chunk of revenues?
The confidence is quite high, and that is all based on confirmed engagements as well as opportunities that we see in the pipeline. Even at the start of the year, we saw that it was going to get to double the number, right, that we did last year. My recent interactions with clients and prospects, again, affirm this conviction that we have. There are multiple engagements where we are now scaling from having executed pilots and POCs into production capabilities. And then there are a whole host of experiments that are being spun off as well, right, by any organization. So in general, the confidence on that number is fairly high.
Okay, Mr. Sethuraman, good morning. Prashant here.
Morning.
Two questions. One, we've been hearing for some time that what's going to happen eventually as a broader, not just for your company, is that this AI thing has now been around for a while. That service providers, like you, would be able to use AI to better your productivity, lower your costs, etc. That's the first phase. The second phase is essentially when your customers will say, well, you're doing it a lot more cheaper. So we want that advantage passed on to us. Is that way of thinking about it correct or not? That is one. And second, how big is agentic AI? People like Eric Schmidt are saying that it's going to really take the dire IT space by storm early next year. It's going to arrive in full force. And what will it do to a business like yours?
Right. No, I think the thinking is absolutely right in the sense that there is going to be a lot of expectation from clients in terms of the productivity benefits being passed on to them. We can very clearly see that in the work that we do. Engagements that used to take, say, 3 to 5 member team, 2 months or 3 months to execute, we are now able to execute with 1 or 2 people, right, in a few weeks, actually. So that's already happening. And when we see that, clients also see that, right, in terms of the execution. You are right that the larger companies, I attended the Databricks Summit in San Francisco a couple of weeks back. They are all investing heavily in building out their platforms and integrating GenAI and agentic AI capabilities into the platform that makes it fairly simple and easy if all enterprise data is on that platform. Now, of course, you still have challenges related to data being across multiple silos. And then, of course, even when you bring in the GenAI and the agentic AI layer to build new apps, to build new reports, dashboards, models, and whatnot, there is still effort that is required, right, in terms of coordinating all of this stuff. The optionality in the system is also increasing significantly with every passing day. So I'm expecting that service providers like us will have to switch gear and then start doing more of AI integration work, just like systems integration work in the past. That's what we are calling it internally, helping clients navigate through the optionality and then help build in the kind of mechanisms that they need for delivering enterprise use cases. The demos and the displays that we saw during even the Databricks Summit were all fantastic, and they're all headed in that direction. So I'm expecting that there will be a lot more of the productivity gains that will start kicking in a couple of.
So, Mr. Sethuraman, since you're acknowledging that, yes, indeed, it'll lower costs. And even though I completely acknowledge that it's going to be AI integration at some level, like systems integration, directionally, over the course of the, say, next 6 to 8 quarters, doesn't it mean lower margins for a business like you? Because clients will want their own share of those productivity gains.
I would say that the margins would not be impacted significantly because we are able to retain some of the productivity gains. Margin should, in fact, be better if we are able to use the tools and the automation that is available. The question really will be around the volume of business, right? And there, the hypothesis that most of us are working with is that enterprises will continue to hold on to their budget and want to get more done using the AI tools and the productivity benefits that are available rather than cut back on their spending. Of course, we need to see how this pans out. Larger firms will be watching this even closely. For us, given the size that we are at this point in time, based on everything that I'm seeing in the market, we feel fairly confident that over the next 3-year period, the growth rates as well as the margin guidance that we have given will continue to hold.
So 23% roughly for this year, for FY26. EBIT at the EBITDA margin level. Got that. Just a word on the top line. Just to go back to that guidance you've given. Your guidance for this year is about 18 to 19% growth. And eventually you want to scale this up to 25%, right? Yep. But at the same time, you also acknowledge that deal closure timelines, especially large deals, they're getting longer and longer. So how does that tie in with your margin guidance? What makes you confident of at least 19% growth this year?
Yeah, the revenue guidance, you mean, right? Yeah, the thing is that some of those engagements and opportunities, we have been in conversation for some time now, and I see some traction on them. So when I talk about longer timelines, it's about new opportunities, new logos that we are trying to break into. There is also evidence where initiatives in the $500,000 range, $500,000, they are still going through. The really big ones, right? Last year, for example, we had a $3.2 million win, right, in one engagement. There are a few conversations of that nature. Those things will take some time, but the good thing is that we've been engaging with many of them for quite some time now, and we are expecting that some of them will come to
the closures will happen.
Yeah.
Yeah, so the discussions are going on for longer, but you're looking at quick closures now with those long engagements.
That's correct.
Therefore, that explains that 19% growth guidance at the top line. Got it. Thank you very much for joining in. Good to get that perspective, and we wish you, quite well for the rest of the year. All right, well, let's move ahead and discuss a lot of the, active stocks today. The stocks in focus with Avnish Agarwal, Director Institutional Research at PL Capital. Avnish, good to have you on. I want to start first with Dixon Tech, actually. Small development. Promoters have sold a little bit of stake, I think about 2.5%. I checked the overall promoter shareholding. It's just a little over 32%. So they've sold a small part of it. Could be for any personal use as well. Your thoughts on the stock?
You see, I think these days you have promoters selling any stock shouldn't be taken negatively, because markets have come up quite significantly, and we have seen a lot of promoters, private equity guys, they are trying to, you can say, in cash. Now, as far as the company is concerned, I think fundamentally it is in a very sweet spot. It is doing well. The growth outlook also of Dixon looks pretty decent. So I won't be able to give you any target and all, but I think in the overall space where it operates in, it continues to be one of the good stocks to bet on.
Okay, all right. Hi, Amnish. Good to see you. When crude oil prices have cooled off, so OMCs are going to be in focus. What's your take? What is the current view you'll have on OMCs, and do you think that it's presenting a good buying opportunity?
Yeah, you see, the main thing is that now crude is very volatile. In a day, it has crashed by nearly, say, 9-10%. Now, if the crude prices remain anywhere within the band of, say, less than 70 or, say, maybe up to 60 to 70 band, I think that is very favorable for OMCs, because their profitability, working capital, all the things get a boost. And conversely, it is to some extent negative for the companies like your ONGC, or your Oil India, etc. So to that extent, I think there could be some sort of trading uptick in oil marketing companies today. However, in the longer term, I think these are very, very volatile companies. One will have to wait and see where actually the crude oil stabilizes. But based on the current day's move where the oil prices have crashed, I think it remains to be quite a likely to be quite a good day for oil marketing companies.
Okay, oil marketing companies, got that. By the way, I'm just looking at a note that CLSA has put out on Nykaa. They've initiated coverage with an outperform rating. Target is 229. We'll just get the Nykaa stock up for you. Did well in trade yesterday as well. Yeah, it was up 3.5%. 203 is where it is, and CLSA feels it can get to 229. They're talking about the rapid growth in the beauty market. And they see as the underperformance phase for Nykaa perhaps ending. That's a CLSA view. Amnish, the reason I picked this particular note out was because there's a lot of interest in consumer stocks again in the market. How to play the rise in discretionary spends, the fact that there's an income tax cut, etc. So suddenly everyone's talking consumer. I don't know if you like Nykaa, if not this. Give us some thoughts here.
Look at in various baskets, even when we were talking about that there is some slowdown in consumption, the discretionary consumption was doing that. So there are absolutely, you can say, no doubts about that. So for example, you look at travel, you look at your aviation, some segments in discretionary, particularly on the premium side, they were all doing well, because the middle and upper middle class, they continue to do well even during that phase. Now, coming back to, you can say, the benefit of tax cuts, yes, it will be there. Now, there could be a very wide basket of products which it could impact. It could impact real estate. It could impact, say, your auto, particularly, I would say, two-wheelers. It could impact some discretionary spending in apparel. It could impact something like your, for example, beauty products. So it could be far and wide impact of that. However, having said that, the problem in the industry today, in addition to, you can say, little bit of growth, is the competitive intensity, because due to these platforms, lot of these companies today, they are going through an hyper competitive phase. So that is why I think it has to be a very, very stock specific call. And even if the consumption demand scenario doesn't look bad, one should not expect any big bubble to happen in such stocks. You will make money, but one should expect maybe you can say double digit 10-12% kind of a return, and not something like 25-30 one should expect from these.
All right. Abneesh, stay with us. What we're going to do is take a quick commercial break here. Up next, some technical trading ideas. Sudarshan Sukhani and Mitesh Thakkar are going to be with us with exactly that coming up. Okay, welcome back. 9 minutes to go for the pre-open session to kick off. Sudarshan Sukhani and Mitesh Thakkar are with us with what they'd want you to do as far as the new trading session is concerned. New morning and new headlines, and I guess a much better picture overall. I mean, if you are bullish, what's your sense, gentlemen? Mitesh, you go first. How is the GIFT Nifty, of course, is indicating a flourish of an opening. But if you get a gap up, that's the question then. Realistically, how do you put in trades?
So, Prashant, I think it will be a gap up, and it will be a big gap up, about 200, 250 points kind of a gap. Now, I think that will also mean that we open around the highs which we made on the 11th of June, which is around 25,220. So I think that's where, I would want to take some profits, but I suspect that this gap up could have followed through. So if you see the markets and indices get past 22,250, maybe then you would want to take a 80-90 point kind of a stop and look at a long position with targets of 22,500 plus.
All right. Good morning, gentlemen. Sudarshan, what about you?
Yeah, good morning. Well, yesterday I had explained why we must go long at every dip, and yesterday was a dip. I'm referring to that only because today is a big gap up, and today is a time when if you have any long positions taken yesterday, this is a very good time to take profits. This doesn't mean the gap up will not sustain, but the chances are after a 200 or 250 point up, a gap up, markets will consolidate and they will also have minor corrections. So perhaps today you can step aside, wait for, if you get a 150, 200 point correction from the opening, and that is possible during the day when a sharp sort of decline and panic can set in, then re-enter and buy. If you don't have a position, buy only on a 200 point dip, otherwise avoid the gap up.
Got that. Sudarshan, let's get through trades specifically in terms of stocks. What's on your radar?
Well, Hindalco is a buy with a stop under 648. Coromandel is a buy. It's coming again in my list with a stop under 2267. Nykaa, which has come the first time, I think, is a buying opportunity with a stop under 200. This is only a swing trade. Keep it for just a few days. And ICICI GI, General Insurance, is a buy with a stop under 1937.
Mitesh, what about you?
Yeah. So I have a buy on Hindalco as well. That's a common stock. Looking at targets of 685 and a stop around or below 650. Polycab is a buy with a stop at 6150 for targets of 6450. Kotak Bank is a buy. Keep a stop below 2166. Look for targets of 2230. And the final buy call is the Scots. Keep a stop at 3280. Look for targets of 3450.
All right, we'll take a quick commercial break here, gentlemen. Thanks very much for those trading ideas. More later. We'll come back with a pre-open session. We'll also have Sandeep Agarwal of Sovilo Investment Managers to discuss, the implications of Accenture's earnings. Stocks, IT stocks yesterday were a little lower. Coming up in just a bit.
Welcome back. This is Open Exchange. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. We're still in conversation with Abneesh Agarwal. Abneesh, I wanted to ask you about VIP. You know, the various reports that are indicating that there could possibly be a deal where PE firms take over from Mr. Piramal. I think as a house, you all were reasonably optimistic on prospects, and I think you all were one of the lone voices that was optimistic on the prospects. What's your view? A stock that was sub 300 rupees is closer to 430 rupees right now. All the good news in the price, even if there is a deal?
Okay, Nigel, one has to look at that the VIP stock corrected from 650, 700 rupees because the company was not doing well. There was too much inventory in the system, which I think over the past 5-6 quarters, they have not brought it down to very reasonable levels. So that is one part of it. And operationally also, inventory went down, warehousing costs went down, and the things should start improving. Now, the second aspect is that the travel is doing well. This time around, 1Q, we have got 1Q and 2Q good marriage season in comparison to what it was not. So to that extent, I think fundamentally it might be closer to the, you can say, bottom. At around, say, sub 300 rupees, the stock had actually declined a bit too much, and it was always in the news that there could be some change in the management, some PE player or some other domestic player might come in. So I think if you look at the acquisition, you can say possibility, then there might be still some room left in this stock because fundamentally things have bottomed out. And usually when the acquisitions happen, because the stock has actually come up by around 15% from the bottom, I think you can see that there could be still some juice, but whether it will be the kind we have seen in the last 2-3 months, kind of that or lower, that is something which we'll have to wait and watch.
Amnish, one is, of course, Z. I don't know if you have a view, was up 10% yesterday, was limit up. And the other is these smaller defense stocks had a field day yesterday. I mean, they've had a field day for a while. Garden Reach, Paras, Zentech, Idea Ford, some of them were up 10% a piece. Any thoughts?
See, as far as Z is concerned, as we talked last week also, that the promoter stake in Z is very low and now they are intending to increase the stake. Now, I think in the latest, you can say the investor communication, which they have indicated is that the losses of Z5 will come down significantly from plus 500 crores. So I think that is very meaningful because for a company like Z, so that effectively means that 2 to 3 rupees addition to EPS straight away if they are able to eliminate those losses. But how will they do it remains to be a very challenging and difficult task because today, I think we are gradually and slowly moving towards, you can say, OTT world. And OTT, you have got, you can say, Jio Hotstar is there, then you are having Netflix is there, Prime Video is there. The competition there is intense. And I think Z is very strong as far as your broadcasting is concerned, but you have to be equally strong in OTT if you want to have a very long-term view, say 5 years, 7 years down the line, where majority of consumption of the content might shift on the OTT platform. So I think because the stock had been butchered, it was lying low. I think it is bouncing back. Now, to what extent it will go, we will have to wait and watch, depending upon, you can say, how the things play out for this particular name. And regarding the defense stock, I think defense as an industry is coming up you can say when the demand for the larger defense equipment goes up, then all the ancillary suppliers will also gain to that extent. So I think going by what is happening around the globe in terms of wars, in terms of repositioning, I think defense stocks will continue to be in the limelight for some more time.
Look at the rupee open, 86.11 compared to 86.75. So that's a big move, rupee strengthening against the dollar this morning as the dollar itself takes a bit of a dive lower. Nothing large, but of course, I mean, here, I think the rupee is especially sensitive because we are such a big oil importer. I mean, the worst case was that there's some disruption with regards to that. So that has not come through. That's not happened. And I think you're seeing a bit of a relief move as far as the rupee against the dollar is concerned. A full 60-65 paise move on the dollar rupee this morning.
That's the rupee, but the equity market pre-open, at least from what we have right now, it's only 1-2 minutes. It's up, but it's not the big surge that the implied open was indicating. The implied open was indicating almost 300 points higher. Right now, the Nifty seems to be a little more measured, just about a 0.5% increase coming through. Some of the oil marketing companies that Nigel was pointing out, they're doing really well in the pre-open session, 4 to 5% up on many of these stocks like IOC, BPCL and HPCL. Amnish, thanks very much for all your thoughts. and the context this morning. You have a good day. But with that, we'll move on now and put the spotlight on the IT space. Accenture, remember, came out with numbers just yesterday, and the company was citing significantly elevated level of uncertainty despite reporting what was a good third quarter set. To discuss what the implications are for Indian IT, we have with us Sandeep Agarwal, fund manager at Solio Investment Managers. Sandeep, great to have you on. Thank you so much. That's the question. Accenture reported a good Q3, but they're sounding very cautious, and some are arguing their bookings have been soft for the future. What's the read-through for us?
Hey, hi, good morning, and thanks for having me on the show. So, if you see the Accenture numbers, I think the numbers were quite good, and also, they have upgraded the guidance, but it was a technical upgrade in the guidance because it was Q4. But I think the problem is that they have made a comment on the call which says that CY25 is uncertain. So now CY25 remaining uncertain means that next year guidance will also be muted. And secondly, if you see the whole story around Indian IT for last 3-4 months since they have started performing was that H2 will be better than H1, which technically is very difficult because you have a lot of furloughs in the manufacturing side in December, and then you have less number of working days in February. But still people were hopeful. Now with this, it also implies that for us also even H2 may not recover at all. And secondly, the stocks have run up quite a bit in last 2-3 months massively. Some of them have gone very, very high. And also, the biggest worry is that for the first time in last several quarters, we have seen a significant, weakness in the outsourcing book, which has never been the case in case of Accenture because they were always doing extremely well on the outsourcing side, and on the consulting they were a little weak. So all these things seems to have one consensus call, which is there that Indian IT companies management cannot give a bullish or a certain guidance when they come out with result on this backdrop. So that is the reading I have.
Slightly out of the box question, Sandeep, since we talk about stocks near term, we will, right? In terms of what you like, etc. Can one of the larger IT companies, really pivot in some way, in a big way? Which kind of, is from an investor perspective, good. But of course, for them, in terms of, latching on to better growth areas instead of doing what they've always been doing. Or you think it's too hard? I'm talking about the larger ones. The smaller ones are nimbler and, we spoke with Latent View, for example, earlier. They're talking about moving from systems integration to AI integration kind of work. But what about the larger ones, Sandeep? Possible?
The larger one, obviously, they are doing good amount of work and they are investing, they are training people and all. But you have to remember the base of the new business, which we are talking about, will be very, very small even after 5 years. So whatever, even if you grow them at, let's say, 30-40%, the impact of that on the overall numbers is very muted. So if you recall, after 2021, many of the mid-cap companies and really mid-cap like Persistent, Coforge, LTTS, LTI, many of them, became 10x, 8x, and they became actually large cap if you don't do a relative comparison with the TCS. So, that happened because these companies' base were small and they were able to grow the new technology at a phenomenal pace. So I think this time also it will not be different. The smaller companies, because they have a small base, the new business which can grow in triple digit or maybe high single digit, all those businesses can really change their composition and the growth numbers in next 2-3 years. So I would say that, from that perspective, the smaller and mid-size ones have that chance, but also remember in uncertain times it can go either way. So it is very, very difficult to comment. And additionally, what I'm hearing on the channels that, there is and I personally believe also that risk is there that, rupee will start appreciating because of multiple factors, crude going down and all. And if that happens, then, the little bit of benefit which was there to absorb the wage hike cost and other costs for the Indian IT companies, that also goes away. So I will be really concerned about the EPS growth X of buybacks. That is what my view is.
Okay, so concerned about overall EPS growth from the IT sector, got that. Sandeep, the point that you made about some of the niche mid-cap IT players that have done so well, right? And they have beaten the large IT services companies hands down. But even there, it's become very differentiated. There are companies like Coforge that have continued to grow well, continued to guide very strong. And then there are companies like KPIT Tech. This morning, we've woken up to yet another I won't call it a profit warning, but basically it's a mid-quarter warning of sorts. They're saying that ramp-ups are very slow, deal conversions are even slower than before. So I'm not able to understand if this is a company-specific issue Or is this ER&D in general? Is it an auto segment issue? Just give us some more color on what's happening with mid-cap IT, where some of the yesteryear stars are now struggling.
So you're absolutely right. You have to remember this is more driven by the industry where you have exposure. So Coforge always had an advantage of having, good exposure to the travel industry, and they have benefited a lot after COVID because of that, because travel has consistently been going up and there have been mass scale implementation of, the softwares, the applications and everything in that space. So they have a big beneficiary of that. ER&D was doing phenomenally well till this, tensions started in Europe and some part of Middle East. And because of that, what has happened, the stocks of ER&D, which were insanely expensive, and at the same time, there is a disruption in the manufacturing side. So both have come together and they have disturbed this, and this profit warning and all, indirect, direct, whatever you are seeing, this is actually because of that. And I think that ER&D is actually a much better theme for long term than IT services. But the problem is that ER&D's PEG ratios are much, much higher than the IT services PEG ratio, although IT services PEG ratio themselves are expensive. So, you have to play more industry specific games rather than, just, mid-size, small size or large cap. That will be really challenging to make money. So I would say you have to get the size correct, you have to get the technology correct, and then you have to get the segments correct. So it is a combination which you have to get right.
So I know you can't talk stocks, so just tell us, where are those pockets where you're getting this beautiful amalgamation of reasonable valuation? Segment seems to be providing some comfort and growth as well.
See, there are pockets in ER&D, very unknown kind of names which are doing decent, and you have to really, really do very, very lot of hard work and research to get them. And there's some pockets in IT services also where the services pieces are in Gen AI and digital, and the sizes are so small that this small percentage can make a big difference. As we run a PMS and we are bound not to disclose any names, but I can tell you that there are 2-3 names in AR&D, there are 2-3 names in the IT services. At least 4-5 names are there where you can still make a lot of money. But yes, in next 6 months they may also not make money because stocks have run up crazy. I am not very comfortable with the PEG ratios which the industry is going through.
Okay, all right. Sandeep, thank you very much. Good speaking with you. Appreciate your time here on CNBC-TV18. I think we've come to the end of the pre-open session. Let's just look at the Nifty at the end of the pre-open. Is it, we look at it initially. So yeah, this is more like it. 200 points, not 100, 200 plus points on the Nifty, 25,000, just under 25,200 is where we are at. So you're going to open up at about that 25,222 level, which is the, first resistance at the upper end of the channel, which the market got to, and then from where it sort of corrected. So you're going to cover that distance right to the word go as the indication. Sudarshan and Mitesh are back with us with the 9-10 call. Sudarshan, what do you have?
Buy Coromandel with a stop under 22.67.
Okay, and Mitesh?
Buy Escorts for a target of 34.50.
Okay, all right. Gentlemen, Coromandel and Escorts are the two trades coming through from Sudarshan and Mitesh respectively. We'll focus on Nykaa and Page Industries now, and what the street is saying. Mangalam is here with exactly that. Mangalam, morning.
Good morning. So two initiating coverages. One on something that makes you look good from the outside. The other one is the one that something makes you feel good from the inside. So we have CLSA initiating coverage on Nykaa. They have an outperform rating, 229 rupees share price target, and they say that the beauty market is rapidly evolving in India, and Nykaa is a clear leader, nearly $16.5 billion in gross merchandise value, has the potential to grow in high teens over the next 5 years. And the only fly in the ointment for them is the Nykaa fashion business, which they don't see as standing out in a crowded space. But they believe that so long as beauty is doing well, driving growth and profitability for them, the drag on fashion is absolutely okay and manageable. They expect the EBITDA margins for the company to expand by 310 basis points over the next 3 years. The only risk is slower than expected growth or faster than expected ramp up of competition. Page Industries, on the other hand, Goldman Sachs has initiated coverage. They have a buy rating target of 52,000 rupees. They say that industry levels for inventory seem to have normalized, so which means that over the next 3 years, they can grow their sales at a compounded average of close to 12.2%, and this is much higher than the last 5 years of around 8%. And apart from the innerwear segment, outerwear segment is likely to do well for them. Remember, that is a high value, margin accretive product. And the management expects to add nearly 200 to 250 exclusive brand outlets. Exclusive brand outlets have a higher salience of outerwear products selling for them as well. So this is another driver for them. All these factors doing well for Page Industries. So both Nykaa and Page in focus today.
Okay, all right, Mangalam, thanks a lot for that. Well, let's hop across to Vinny. She's here to tell us about KPIT Technologies. Vinny?
Hi, so like we spoke earlier, KPIT Tech, that mid-quarter update that's coming from the company, not anything exciting there, right? Business environment they're seeing is weak. Deal pipelines and the conversion over there is much slower than expected. Demand in US and Asia is also not that great and a bit uncertain. In Europe, yes, it's good for the company. And ramp-ups, that is also at a slower pace is what they're seeing in terms of wins coming in there. Profitability could be a bit of a hit because there's not going to be any one-time gain. Other income could be lower as well this time. So that's a bit of a concern coming in here. Now, on the back of that, Kotak Institutional Equities is saying that they're giving a sell rating, target price of 1,000 rupees per share, and they've cut the EPS for FY26 to 28 by earnings growth actually by 3 to 4%. Now, JP Morgan too is saying that they've given a target price of 1,500 rupees per share, but now they believe that Q1 FY26 could see a decline coming in, and even the bounce back in Q2 could be slow, but that's something that they will watch out for. Before Q2 FY26 come in, Q1 will be a weak quarter. They've cut the organic growth by 4% for FY26 and also cut FY26 to FY28 CAGR growth from 16.5% to 14.5%. So some bit of a muted performance is what we're expecting from KPIT Tech in Q1.
Okay, all right, Vinny, thank you very much for that. So KPIT in focus. We're just about under a minute away from market open. And we look at, of course, the 200-point gap up, which perhaps we should get around just under the 25,200 level. And then we look at the other indices, stocks, of course. I mean, it's a very sort of oil-related look at stocks, I guess, right at the beginning. And then, of course, we'll look into other stuff as well. But thematically, oil marketing, oil producers, paint companies and the like, etc. I mean, we've seen a big decline on oil this over the last 12 hours or so. So what do we have coming up in just a bit from now? We've got the first rate starting to tick in, 25,170. Nifty Bank is up about 0.8% as well, I think. So just settling down there on the Nifty Bank. Yeah, now you got a firm 0.8. So both are starting very, very strong. Small cap index is up even better, 1.2%. The mid cap index is up about 1% or so as well. So this is the overall picture on the indices which are starting up. Right out of the gates, I mean, it's everything up. Some 8 is to, not 8 actually, some 15 is to 1 kind of advances decline ratio. But this is just the first 30-40 seconds that we're looking at. Heat map on your screen in a bit should give you a sense. I think it should be all up kind of a day. We'll just have a look at that. Okay, you've got 2 names down. One is the oil producer, the other is NTPC. But apart from that, 48 out of the 50 names starting the day in the green. And we are past that 25,222 level, which is the first resistance for the market. Let's see if you're able to hold on to these gains. Surabhi.
Yeah, it's an all-green kind of a day. Take a dart, throw it anywhere. It'll land on the green side of the board, that sort of a day. In terms of sectors, by the way, PSU banks are having a very good start. PSU banks and PSUs in general, UCO Bank, Aircon, Union Bank, lots and lots of those stocks on the upside. And of course, there are the PSU oil refiners, HPCL, IOC, and BPCL. Nigel was alerting us about them in the morning. And indeed, they're up between 3 and 4%. So PSU pack is looking good. On the Nifty, everything is up, but the biggest gains coming in for Adani Ports, 4.5% up on that stock. There's Shriram Finance, about 3% up. Geo Finance, Adani Enterprises also. There's Ultratech Cement, it's M&M, JSW Steel, I mean, you name it. It's just a long list of winners. IT is also fairly strong this morning. TCS, Wipro, these stocks are up between 1 to 1.5%. You've got Reliance up about 1%, SBI, HDFC Bank, ICICI Bank, all 1% gainers, looking really good. The only stock that's down, obviously ONGC is not a surprise, down about 2%. NTPC is down 2.7%. We'll just look a little deeper into this and see if there's any particular reason. About 3% lower on NTPC, making it the biggest loser right now on the Nifty. But otherwise, solid looking screen. 260 points higher on the Nifty, Nigel.
Well, that's right. From the broader markets, a few more stocks just to highlight. Enviro Infra Engineers, that stock is in focus. They've secured projects worth around 300 crores in Chhattisgarh. So that explains why Enviro Infra is higher in today's trading session. Idea Forge had a good close to trade yesterday. The stock, I think, has more than doubled from the recent lows. Today, as well as opening on high volume. So Idea Forge as well as higher. Let's pull both those two up. In Enviro Infra as well as Idea Forge. Both of them should come up for you on the screen. You have Bagel Projects, that's won an order yesterday. I think we have the management schedule later today. That stock, in fact, is up and about in today's trading session. So solid up move is what we're seeing on that particular name. And the other one is Avalon. Nimesh had alerted that could be a large trade. I think that large trade has taken place, on that particular name. So Avalon as well is a little bit low, but that's courtesy the large trade that we've seen. KPIT Technologies, commentary a little bit skittish. The street is taking no note of that. The stock we're talking about is Avalon. So pull up Avalon. KPIT is lower as well because of the skittish commentary. But all in all, a solid start to trade. We hope that we end closer to these levels. The crude sensitives, well, they are on fire. OMC is up and about. BPCL, HPCL, IOC, all up between 3 to around 5%.
All right, we've got the market holding on so far. 250 odd points in the 250 odd points higher is what you have. I mean, the other one is Indigo, which is up about 3.5%. By the way, Indigo is the largest volume-led gainer right now. So it's a pretty straightforward kind of screen. Adani Ports, interestingly, is the other one, right? I mean, they've got, that port in Israel, which they operate. So that's up about 4% as well. I mean, the oil stocks, of course, are there. What else? I mean, Page Industries is up 3.5%. Mangalam was talking about Page. Hitachi is up 3%. Union Bank is up 3%. JM Financial is up about 5%. And you go down the list, Aarti is up 4, PG Electroplast is up 3, lots of stuff coming through. And this is early on, in the first couple of minutes of trade. K Fintech is up about 2.5%. So lots and lots of movers at this point in time. And of course, it's predominantly on the upside, nothing very much on the downside at all. I mean, some reversal. So I was talking about defense, right? I mean, if defense should go up as conflicts rise, they should perhaps cool off a little bit as conflicts abate. Cochin is down 1, Garden Reach is down 3.5, HAL is down 1.5, Mazgaon is down 1.7, BEML is down 2.5, Bharat Dynamics is down about 2.5%. So if you look at the defense names, they're all kind of seeing a little bit of profit booking, nothing very much. I mean, they've all been such big winners. MRPL and CPCL, Chennai Petro, were both up between 7 and 10% yesterday. I think they're also cooling it a little bit, apart from the straightforward oil producers like ONGC and Oil India, which are down 2.5% and 3.5% respectively as well. So, as I said, it's a thematic kind of a day, but there is a broad lift coming through as well. 25, 240 is where we're at. Shreyash Devalkar is with us of Axis Mutual Fund. Shreyash, good morning. Great to have you back on the program with us. Appreciate it. Let's just hope now that the ceasefire stands and it's a bit of a clearing event for markets, and we can look at other things now. So, what are the other things which the market is going to focus on? Does the market need to readjust at all, or I mean, this 250 odd point move that we have today? That's it. I mean, we didn't see any large risk off on the back of the conflict in the first place to begin with. What's your sense?
Yeah, so that large risk off one definitely was not there in the market. And in that context, definitely when it comes to, it's internal sector rotations. So we have seen some correction actually a little bit correction in the stocks which are crude oil price sensitive, and those stocks actually have seen some reversal after that. At the same time, overall from here on, if we want to look at what next, then definitely this overhang of geopolitical issue, whether with this development, whether it is over, and we should move on with the domestic as well as other export-oriented parameters. So if we try to move on with that, few parameters are there. Definitely, we have seen rate cuts. We are seeing now crude oil prices coming down, and its impact on overall credit growth. So what one should look forward to is with cut in the CRR, the cut in the repo rate, and improving liquidity, how the credit growth will shape up from here on. because there are 2-3 elements which are in their favor. One is liquidity. Second is now the ECB. Actually, versus ECB, the domestic loans are actually much better, and that should give some kicker to the credit growth. And lastly, the retail credit growth may actually come back. So with this, I would actually look forward to that piece on an overall macro front, when and whether it is coming back and how soon it will come back with the festive season just few months away. So that is one part. On the exports front, there has been uncertainty because of tariff to these geopolitical situations. That overhang also is everyone is watching out for. In my opinion, if you look at IT, then in case of IT, that overhang need to come back, need to subside from here on. So that is the other place and where the valuations are reasonable. And thirdly, the other space where the valuations are reasonable is auto. So I'm just highlighting the spaces where the valuation compared to pre-COVID are reasonable, which is banking, that is lending, then there is auto, and then there is IT. So in these spaces, if there is some chance of growth to come back, then market should look forward to it.
Okay, IT and auto, these are some pockets you're looking at. Got that, Shreyas. Good to have you on. That was what I was coming to, just to understand the broad house view where you're looking to place new bets. We just had a discussion on IT, and I think it's still a debate out there because we're not getting the kind of growth numbers that the market would like to see. I mean, large cap companies are still giving you anemic growth, mid-single digits, not even seen high single digits in a while. And mid-cap companies, they're not all moving together as a basket. Some are up, some are struggling. Can you just expand on that point on IT? How do you find valuations and why are you willing to look at it?
Valuations-wise, definitely one comment I might have made earlier on this show that yes, this sector has, despite slowdown, this sector has not got derated. So the first decade of this century, the growth was 15% and the multiple was 20-25. Second decade, the growth was 10% and the multiple was 15 to 20. And now the growth is around 5% and the multiple is around 20-22. So with this, as far as valuations are concerned, on the PE basis, definitely the valuations are have not corrected commensurate to the growth slowdown. On the other hand, the cash flow profile of this sector has improved a lot compared to 2 decades ago. And that's where, including the dividend and buyback, that actually lends some support for the valuation, and especially in the context of every other sector, which has got re-rated a lot. Now coming to the growth, so obviously without growth, nothing moves up in India, just because whatever metric of valuation we can use, it may be free cash flow yield or it may be PE basis. So on the growth front, that's what my point was, that yes, with the global uncertainty. So the global uncertainty is leading to the indecision. And that indecision first started with the tariff uncertainty and now with the geopolitical issues. So on both these front, I think the tariffs and the negotiations are on, and probably we are at the fag end of it. So that is one. And secondly, on the geopolitical situations, if this subside further. So in both these situations, if the growth for the sector improves, then there is a chance. Now, as you're rightly highlighting, the large versus mid and small. So the large cap, actually recently there was a result of Accenture as well. The large cap is seeing some pressure on overall growth for some time. And that's where the opportunities are to be found out in the multiple sub-segments of IT. It can be in the niche segments, the companies which are focusing on the niche segments in this. And some companies are there in the products as well. And some companies are there in engineering R&D. So it need not be the traditional way of investing, wherein the growth would depend more on the revival of the global outlook. But at the same time, there are pockets where there can be growth.
Hi, Shreyas. Good morning and good to see you, Ben. What about travel and tourism? You're quite bullish, I think, on the prospects out there. How do you play this theme, though? You have hotels, you have, the one listed, quality aviation stock. What's the view out there? How do you play this entire travel and tourism theme? Hotels, what else?
So in travel and tourism, there are multiple aspects. Definitely, see, this sector now is a discovered and established sector. So actually, so is most part of the market where there is a, so to say, structural growth in last 2-3 years. And those, this is hotel and basically tourism is one of them, like EMS services and manufacturing. So hotel tourism is one of them. This sector being already discovered, there are names obviously in the hotel space, they are in airline, or with airline there are not many options. Then you have certain companies which are derivatives. Some companies are there in the IT as well, who are focusing on the niche areas of tourism. There are players also in the luggage segment, but then their growth has been patchy. But then market should look into it when the growth comes back in that segment. So in all segments, actually, the what market is focusing on is the segment where there is a consolidation and there is a few winners, few clear-cut winners, which are emerging without much incremental competition. And that's what you are noticing, that market has flocked to those. While there are certain segments where there is a competition. Now, the luggage segment, there is a competition. Newer brands are coming. And in that context, though the sector is doing well, the companies may not have done well the way you wanted. And that's where it's a combination of both sector tailwind and consolidation in the sector, and you being with the winner.
Okay, all right, got that point. Overall on earnings, Shreyas, I mean, that's the big hope for the market, right? That eventually we'll get a revival. FY25 was an aberration. What would you say? 10 to 12%, more than that, less than that? What do you expect on the earnings revival front?
I think actually FY26 already, in my opinion, the earning cuts have happened because earning cuts were there for last 2 quarters now, 2 to 3 quarters since September quarter, especially it started big time. And with these earning cuts, which we have already seen, in my judgment, FY26 earnings probably may not see further cuts because all the issues which we market knows, which is the NIM impact on the banking sector, which is high weight and which actually drives the earning for the Nifty 50 or any large cap index. So in that context, most of this news and earning cut for FY26 is there out there in the market, and I in my opinion, it may not get further cut. FY27, obviously, that earning scenario has to emerge from here on, and in that probability is there. Yes, you may see some earning cut on FY27, but FY26, I think it's probably there.
Okay. All right, got it. Shreyas, good talking to you this morning. Thank you very much for joining in and giving us perspective on the market. The market continues to chug along quite well, actually. Before we move on to our next guest, quick stock, 25,200, right at the top of our recent trading range. And this is a range that's been on for a good month now, and we're right at the top of it. So let's see, 1% higher, looking good today on that screen. The next sector that we're putting the spotlight on is actually the hospitals in the healthcare space. Now, we had big news come in over the weekend. Amazon has announced its entry into the sector with the launch of an at-home diagnostic service. PB Fintech, of course, we know, is going to be investing close to 700 crore rupees in its healthcare arm. They're looking at building their own standalone hospitals, and maybe the first of those hospitals would be completed by the end of this year. Let's discuss these developments and what it means for the sector, for patients, for the incumbent players. We have the management of Narayana Healthcare now joining in. Narayana itself is looking to offer integrated healthcare services across the board as well. We have with us Sandhya J, Group Chief Financial Officer at Narayana Health. Sandhya, always a pleasure to welcome you on our shows. And like I said, I mean, it was a slightly long preamble, but just to put things in context, because there's a lot changing. You yourself are looking at clinics, you're looking at insurance, you're looking at a far more integrated healthcare offering. So what does this changing landscape really mean for competition, for patient services? Opening thoughts.
Good morning. Thank you for having me here. So if you look at Narayana's mission and what we've been trying to solve from the day we started, we've been trying to solve for accessibility, affordability, and availability. And that is really the goal of healthcare. So the more players that come into the market and with different perspectives. So for example, Amazon comes with a very heavy tech-enabled service orientation, which is a positive movement to the market and so on and so forth. So we do believe that these are positive developments to the sector. Coming closer home, I think as regards to our own integrated care journey, we believe that we should take responsibility to keep our customers healthy and not treat them when they're sick. And that's the premise in which our entire integrated care business has been built. And we are hoping that we are able to create that value to our customers.
Sandhya, can you give us some more numbers with respect to your own foray? Before we talk about, the entry of other players like PB and Amazon, just, set the stage for us in terms of the clinic program that you have, the launch of clinics. How much money are you putting to work? When will this business be profitable? And similarly, insurance. What exactly are your plans and what are the targets there?
Sure. So we have already launched more than 10 clinics in Bangalore. We have about 4,000 people, lives insured in our insurance plan. We don't look at these as separate developments. We look at them as a holistic way by which we offer care. So which means that the clinics work closer to where people live and therefore more routine care for people. And when they are in need of coming to the hospital, the insurance operates like a financial enablement. So that's really the model. The other part that we are trying to solve with the insurance business is we are trying to solve for the missing middle, which is people who don't have access to many public healthcare who cannot afford insurance today. So it's a low cost, no frills insurance. So that's the other segment that we are targeting for. From an investment point of view, we've committed 400 crores in this business over the next 3 to 4 years. Our break-even will be cohort by cohort. Like, for example, the first set of clinics that we established, the first cohort of clinics, they've completed 18 months and they've already broken even. The second set of cohorts are now going through that journey. So it's a cohort by cohort model. The same thing with insurance. We would take insurance into a particular city. So right now, for example, we've launched insurance in Bangalore and then we're
got that.
in Calcutta. So we're looking at a 2-3 year break-even period on a city-to-city basis.
Right. Got that. And good to get those plans across as well. Sandhya, good morning. Prashant here. Now, let's just talk about Amazon Diagnostics, right? Is it going to be a threat to players like you, to other players in the system? It's a tech giant. They're promising fast turnaround reports. I mean, routine test results within 6 hours. The reports to be found on the Amazon app. Of course, they'll do what they can. But as things stand right now, with the information we know, do you think there will be a threat?
I cannot comment for other players, but for us, we don't see them as a threat because we've always said that diagnostics is very important. Preventive is very important. A lot of the healthcare that people are availing today is because they did not attend to themselves on time. And growth of a diagnostic business only enables people to manage their healthcare better. It will definitely motivate players to invest in tech and be more customer focused, which is where the industry has to progress. For example, if you take Narayana, most of our reports are delivered in less than 60 minutes on the app. And it's a total digital experience. So we've already cracked that model inside Narayana. And it will probably motivate us to do more and more of that so that we are able to match up to the how the demand is being consumed.
In a way, do you expect them to act as an aggregator, Sandhya? Amazon, their entry as you see it?
See, I cannot comment for their strategy, and they always try to pivot along multiple axes. So I'm guessing that they may want to look at aggregation as an axis as well, but I don't think it's my place to comment on that.
All right. Hi, Sandhya. Good to hear your thoughts. Well, on integrated care, you mentioned a couple of times. I think last year the cash burn was close to 65 crores. Do you see this coming down this year? And I just want to revisit the break-even timeline for that.
So we've committed about 400 crores over 4 years for the integrated care business, which is insurance plus clinics. We will burn cash in the integrated care business. That's because we are opening more clinics. So at a cohort by cohort level, we are breaking even. So this year, we will not reduce the cash burn, it will increase. But our first set of clinics have already broken even, and we will continue that cycle.
Yes. Got it. Okay. All right. Specifically on the insurance part of the business, which is also part of integrated care, as you said, could you give us some more color? You'll have launched a new product. I think it's Arya in 2025. So if you could, give us some kind of number, some kind of guidance, premium growth you're targeting, number of policies you're looking at in FY26?
So we haven't publicly disclosed the numbers that we are targeting, but we are looking to grow in the focus markets, which is Kolkata and Bangalore in FY26. So these are the key markets. And of course, there are other markets that we will expand into. We are already present in Mysore. Now, the model is that it's an integrated experience. So we start with a proper intervention in terms of what are the health needs of the individual, and then we build on the journey along with that. So it's not like when you fall sick, we'll pay for you, but we will manage your health. So that as a concept is taking some time for people to understand and latch on to. So there has been a slow progress, but this is the model we want to build. So we are fully committed to growing this business. So we will be able to share more numbers as we start building out.
Sandhya, so just to understand this insurance piece further, I mean, you're a hospital chain now looking to offer insurance solutions. PB Fintech was an insurance aggregator platform, and now they're looking to set up hospitals, get a separate company going with separate set of investors. So we're just trying to understand, I mean, how this really works out and what's the end game for you. Of course, I mean, better solutions to the customer are well taken. I'm just trying to understand from a business perspective, how will this be priced? What is the scale up that you have in mind? And what will it mean for you in terms of profitability margins? Just explain the business in this.
For integrated care?
Specifically for the insurance business that you're setting up. Not clinics, just insurance.
Okay. So our insurance business model is similar to other insurance providers. The only difference being that it has a lot of preventive components inbuilt into it. So, and we are also, because we work very proactively regarding the health outcomes, so we also have access to a lot of data, because of which we are able to proactively manage the health requirements. So the way we have priced our insurance product, number one, it factors the element of trust. And we have spoken about the ecosystem of trust, and I don't want to repeat it. That helps us bring the costs down. The second part is that because we are proactively intervening, therefore the cost of care also goes down. So that is priced in, and that benefit is passed on to the customer. So that's our financial model. So just give an example, Aditi is a policy which is priced at about 1,000 rupees per month approximately for a family of 4 for a 1 crore coverage. Now, it just looks like a lot. That kind of policy doesn't exist. But the reason we are able to do it is because the care is managed completely inside our network, and it is managed in a proactive way. So that helps us build the cost, bring down the cost. And that helps more people who don't access insurance today access insurance. So that's really the theme with which we are building this.
Sandhya, we'll leave it there. Thank you very much for joining us. Good speaking with you, and good luck. It's done very, very well. The business and, of course, the stock as well. That's Narayana Health for you. But, I mean, in terms of Amazon Diagnostics, as Narayana looks at it, not a threat, at least not at this stage, more tech-enabled sort of online aggregator at this point in time. We'll take a quick commercial break here. We're going to come back with an interesting conversation with a new IPO, which is coming up. A well-known brand, especially here in Mumbai, Kalpataru. The management is with us here in our studio, so going across to them after this quick break.
Well, Mumbai-based real estate developer Kalpataru is going to be raising around 1,590 crore rupees, and the subscription for the IPO opens today. Do note the company will utilize close to around 1,200 crores for debt repayment and other general purposes as well. Joining us on the show today, we have Mr. Parag Munut, the managing director, and Mr. Chandrasekhar Golekar, the chief financial officer at Kalpataru. Good morning, gentlemen. Thanks a lot for coming down to the studio. I was just looking at the anchor book and some solid names have featured out there. So good on y'all. That appears there's a fair bit of interest, and I think we should pull up some of those names on the screen. That said, this is going to be a fresh issue. So all the money comes back, and primarily it's going to be used for debt repayment. As I mentioned earlier, around 1,200 crores of that will be used for debt repayment. So a couple of details. What is the interest cost savings on this 1,200 crores? That was what were you borrowing at, point number one. Point number two, the debt number, if you could update us, post this 1,200 crores, what does it come down to?
Thank you, CNBC. So we are quite pleased. I mean, it's the first day. I mean, issue opens today, and this is really good to have us on CNBC. Thank you very much.
Appreciate it.
So the issue is of 1,590 crores, as we know, and precisely 1,192 crores is the debt repayment. All of it is going to the financial institutions and bank, which will reduce yearly interest. Minimum reduction will be around 100 to 120 crores or so. So far as the debt equity ratio and everything, because today the net debt in the books as of December, which is the reported accounts in the financials, is around 11,000 crores. From there, if we reduce the promoter CCDs, which then later got converted into equity in the month of March, just 3 months ago, and the cash and bank balances, what remains is 9,200 crores. So from 9,200 crores, it will come down to 8,000 odd crores because of this 1,200 crores repayment. And the equity, because of the conversion of CCDs, I mean, the conversion happened at 1,440 crores worth of conversion. Therefore, the equity rose to 2,500 or so. December was around 1,500, then 940 crores got converted. So 2,500. And that further will increase to 4,000 because of the 1,600 issue.
Yes.
So post-issue, it will be therefore just below 2 or so.
So it comes down to ballpark around 8,000 crores. Got that?
Roughly.
Got that number. Are there further plans? Because this is something that could be plaguing investors with regard to the debt on the books. You have explained that you're sounding pretty confident as well. Are there any other plans to reduce debt? Maybe some land parcel monetization, internal cash flows as well will come about. So just on this debt part, are there plans to reduce it further?
So yes, absolutely. So organically, the real estate debt, we need to understand how the real estate sector works. So in real estate, it's a capital intensive sector. More so if it is in MMR Mumbai, where prices are as such high.
Yeah.
So in the initial years of the project of 1 to 2 years, maximum 2.5 years, the capital is provided in two forms. One is equity, another is debt. So debt is an ingredient part of this whole mechanics. Now, when the debt is utilized for the underlying projects which are throwing cash flows, which we typically call it as ongoing projects, which we have 2.5 crore square feet, out of which we will be actually delivering around 1 crore square feet, 11 projects in FY26 and FY27 together. They are going to throw handsome cash flows, net operating cash flows, because almost all of the land cost is fully paid already in past. And that represents actually part of the debt, frankly.
So the cost has been taken up front and the revenues will come. So let's just start from a little bit of basics. Gentlemen, thanks for coming in. Parag, if I can come to you. Tell us a little bit about the, the business per se. This is, for our viewers who don't know, it's a well-known brand, I mean, and it's very visible around the city. But just tell us a little bit, what segment are you in? How much, I think, Mr. Jogelkar mentioned some land parcels, etc. How much developable area you have? Just the basics. I mean, give us a sense of the size of the business.
Thank you, Prashant. Thank you, CNBC. Yeah, we are a 55-year-old brand, so we have been in the business for 55 years. Started from Mumbai. We have been in the whole region. We are one of the only developers who have been across all the 7 micro markets of Mumbai. So starts from Altamont Road, Carmichael Road, all the way up to Mira Road or Thana. We've been in Thana for about 30 years. We've worked in Panvel and all. So we have a deep insight onto the market. At this moment, and Pune, we do Pune. We are Pune for 30 years. At this moment, we have about 50 million square feet. That's about 5 crore square feet of projects which are broken up into ongoing, which is about 25 million square feet, 2.5 crore. Ongoing means they're going across every micro market. These are in 25 projects. And the forthcoming is which we launched in the last 6 months, because after we filed the DRHP, or in the next 18 to 24 months we launch. That's about 16 million square feet. That's about 1.60 crore. And the balance 5 projects, which comes to about 7.8 million, about 78 lakh square feet, is planned, which will get launched from 24 months to 36 months. Now, this 50 million square feet, as you said, it's out of that 75% is own land. So we've paid all there's no litigation, nothing, all clearance are there. The balance is a JV, JD, and redevelopment. You know, redevelopment has become a strong thing in Mumbai. So we have some of them going on. We're doing redevelopment from 15 years. What we play across is play across from luxury, premium, aspirational. We have across the whole field, all spectrum. So we have a deep insight on what customers are wanting in each field. So case in point is our portfolio at this moment of projects, our inventory, 70% is sub 3 crores. That means Mira Road, Thane, Mulund. So we have that cycle. 10% is between 3 crores and 10 crores. And the balance 20% is 10 crores plus. So we know what customers want, customers demand, and
in terms of the business, Parag, just one thing, is it, you said that, are you moving towards more JDs and, I mean, not acquiring land outright, I mean, more asset light, is that the way forward? What's your sense?
For the near term, it is an asset-light model, as we have enough lands which we have bought. And because of the DCR regulation changes which has happened in Mumbai, the redevelopment has got a lot of boost. It's making Mumbai younger. It's making, with all the amenities and facilities within the Mumbai, everybody has to have additional parking, amenities. So that, we are doing redevelopment from last 15, 20 years. So that will give us a lot of boost. So that will be the growth.
So, Mr. Manoj, actually I had a big picture question, but since you brought up redevelopment, let me take up this part first. Help us understand from an operational perspective and a margin perspective, how does a redevelopment project compare with, say, a project where, you know, whether it's a JDA or whether it's, you know, a project based on your own land? I'm just trying to understand the brass tacks of the business.
So in redevelopment, your investments are less because
Absolutely.
You're not buying the land.
Yeah.
And especially in redevelopment, once all your approvals happens, then you tell the society to move out, then only your investment happens in the land.
So how much higher would the profitability or the margin, say, on such a development be?
So margin-wise, it would be about 25% and all that. When you own land, your margin would be higher because you get the capital appreciation also on the own land. Could go higher.
Okay, Mr. Joglekar, I think you want to just add a point. No, and the mix that you'll, I mean, in the next immediate 1-2 years, what will the mix be? And what will that imply for margins?
So, first of all, today we are 75-25, as Mr. Parag mentioned.
Yeah.
So, that will generally continue for 2 years. Because, you know, we will add more properties, but that will take time to come into the launch, etc. So far as margins are concerned, is absolutely right. Initial capital investment in the redevelopments and joint development is very, I mean, compared to the greenfield land acquisition, it is quite low, number one. And greenfield land acquisition takes little more time to develop because we have to go through the title, the approvals and everything. Therefore, the land appreciation, whatever rate we get, that is why the margins there are higher than the redevelopment. And because in redevelopment, once we execute definitive documents, we have to immediately
and you have to hand over the project.
So the time gap is not much.
Okay, so Mr. Manoj, now I'm coming to the bigger picture question. The Indian real estate space is going through a lot, right? Largely family held, but now it's getting corporatized, from the Oberois to Macrotech to so many companies have come to the market. Now you're coming in. A lot of companies are also having pan-India aspirations. I mean, look at the Bangalore boys, Prestige and all of them coming into Mumbai. How intense is the competition in the Mumbai market for you? And will you also think of going out of Mumbai, Pune, this zone anytime soon?
Sure, good question. There were top 7 cities of Mumbai. Out of that, the sales happen in 50% of sales happens in MMR region, Mumbai Metropolitan Region, and Pune. The launches and sales. So this is the biggest market in a way. In that, we being there for so many years, we have a deep loyalty, reputation, customer experience. So we don't feel the competition to be so much. We definitely will go out. We have one project in Hyderabad. Hyderabad is a deep market. It's a growing market. We completed, it got good sales. The first phase completed, second phase 60% sold out. We look at there. We finished one project in Noida, fully sold out, did well. So there is, but at this moment, because of great opportunities in the MMR and with the infrastructure boost finally coming in MMR in the last 10 years has really made a very attractive market.
Just one question, Parag, on the timing of the issue itself. Any thoughts? Why now?
Why now? Maybe we should have done it earlier. But we thought
because we've had a very strong last few years of real estate, right? I mean, so you could have gotten in early. You're coming in. I don't know. I mean, any thoughts on the timing?
So we have another listed company. So we know the play of listed company. We realized that we should come when we have the right amount of projects and we have a right runway for the next 4-5 years. And we were all there. So all these 25 projects and the other projects, we got them all ripened up. And that's the reason.
And for the industry, which year in the cycle are we in? Normally in the 10-year cycle? It's going to be interesting because your IPO is open today.
Middle of the cycle, early part of the cycle, where are we?
Some clues from the analysts and all the analyst agencies which they do. We have average inventory of 16-17 months in MMR.
Okay.
Ready to move in inventory is almost negligible. When these are the two parameters, we should always keep watch on this. That means that geography where, I mean, what this data relates to is not picked up.
Okay, all right.
Okay.
That is point number one.
Months, okay.
Which was earlier 35 months.
Okay.
3 years back.
And just to add to what Parag said, is that why now? So as the projects, we launched 1 crore square foot of projects in last 3 years. And we are completing 1 crore square feet of projects in next 2 years. I mean, 26 and 27. And secondly, promoters have infused 1,440 crore, almost equal to the size of IPO, just less than that. In March, in form of equity in the company at 517 rupees per share. So for the viewers to note, promoters have infused 517 rupees per share and the issue is being offered at 414 rupees, I mean, at a higher band.
That's how you must have gotten, right? GIC Singapore, Bain Capital, SBI Mutual Fund, SBI General Insurance. I'm sure that had something to do with convincing those marquee investors to come on board.
Well, thank you very much, gentlemen. Good luck with the issue. And I think this will be the first of many interactions over the coming quarters, years. Thanks very much, Parag.
Thank you. Thank you, Prashant. Thank you, Surabhi. Thank you. Appreciate.
Yeah. Okay, well, that is the Kalpa through real estate business, which is coming to the market. So watch out. Well, I just move on now, and we are now joined by Nikhil Bhandari, a co-head of APAC Natural Resources and Clean Energy Research at Goldman Sachs. Nikhil, thanks for waiting. Good morning. Appreciate your time here on CNBC-TV18. I'm looking at the title of your report, The Great India Energy Climb. So let me ask you, let me throw it open to you. Just the top 2 or 3 takeaways from the main points that you're making through this report, Nikhil. You tell us.
Yes, absolutely. Thank you guys for having me on the show. Now, look, the main anchor punchline is that we are seeing a structural shift in India's power and the energy demand. We now expect the power demand to grow at over 7% per year through FY35. Now, that's a significantly faster run rate than what we previously expected. The important thing is this isn't just driven by data center, AI, or EV charging, which is the theme of the West for the power demand growth. What's really driving this is the income growth. As more households move up the ladder, they buy more air conditioner, washing machine appliances. So that's driving the growth. The big push towards the manufacturing is driving the industrial power demand growth. So again, we're not upgrading our GDP forecast. We're just upgrading our power consumption intensity to GDP forecast, leading to this punchy power demand forecast number. Now, the other thing that we have done in the report is we have looked at the supply side. Where are the likely bottlenecks in supplying this demand growth? The first one we've talked about is the potential ceiling for the growth in the renewable capacity. After a huge runway of growth in the last 10 years, we have some technical constraints around ramping up renewable at a similar pace for the next 5 to 10 years. So we talk about the bottlenecks there and what's needed to break the bottleneck, which is the battery storage. We also talk about more thermal capacity still needed to avoid a potential energy deficit, which could be as much as 9% by FY35 if we go with just the current pipeline or the current target of the thermal capacity addition of the power system. And the last bit is the bottleneck is the distribution electrification. We've done a great job electrifying our generation, transmission infrastructure, but distribution, the last mile, still needs to be electrified. and our transmission and distribution losses are still high at 18% versus the world average below 10. Now that sets up the investment themes, because investors need to own the bottleneck in order to create alpha from a stock market perspective.
So across these three themes, Nikhil, talk to us about how to play on the equity side. Just take us through one by one.
Yeah, sure, absolutely. Look, we can't specifically talk about the stocks, but I'll put the framework here. So the opportunity clearly for investors is to own the bottlenecks directly. The first is on the renewable side. The bottleneck on the renewable side is not the solar cell or solar module manufacturing anymore. We're already in overcapacity for modules. In a year or two, we'll be in overcapacity for solar cells as well. Our demand constraint, our demand size is going to be more limited. We are already growing 25 gigs solar per year. We can get to the run rate of 30, 35. But if we keep doing that for another 2 to 3 years, we have a theoretical limit on the coal, because you need a larger base load. And in order to, when you're 45% of the capacity mix is solar during in your total power capacity, we have to flex down coal during the morning time when sun is shining, and there is a theoretical limits around it. So that defines the demand for me. If demand is growing 30, 35 gigs a year, we have more than enough solar modules and cell capacity coming online. The real bottlenecks here are the polysilicon, the batteries, and somebody who can take polysilicon all the way to create into module and power out of it. We think that is the business model which is eventually going to survive. So that is one. The second is who's going to help us create more thermal power generation, given we have a 7% power demand CAGR, and we have some constraints in the growth in the renewable capacity after reaching this huge size of 45% in the capacity mix. So thermal generation is another bottleneck. And third is the distribution. It can be played through either the equipment side, because we need to electrify the last mile distribution. We need to put more smart meters, more low and medium voltage distribution lines. And for that, we also need the companies who can work on the ground and electrify the distribution and privatize the discom. So again, those are the main themes that we are focused on from a stock picking perspective.
Yeah, I know. We're regretting the fact that we can't get down to individual stock names, or understand that you have limitations, Nikhil. But just talk to us at least about this. I mean, investors could look at an integrated player like NTPC that's doing everything from thermal to renewable to even nuclear they're getting into, or maybe a Tata Power that's looking at both ends of the spectrum. Or you could try and target niche stocks and niche companies. For instance, I mean, mentioning offhand, there was this news item on NLC India. They're setting up a battery storage plant now in Tamil Nadu. So what should people look at niche pockets like the solar cell manufacturers or someone who's setting up, a battery storage system? Or are you just best off with integrated players for the next 1-2 years?
Look, our call is really to directly own the bottlenecks. And the bottlenecks, as I mentioned, are who can make the polysilicon, who can make the battery cell, not just the battery packs. Cell is the harder thing to do, not the packs. Packs is a low entry barrier business, but cells is really hard. Who can manufacture the cells? Who can really provide me the equipments for the last mile distribution electrification? And who can build the thermal generation for us? So again, to us, it's more about owning the bottlenecks directly rather than we own every piece of the power value chain. Look, there has been a strong beta in the sector 1 to 2 years ago, and that's because we started seeing power deficit. And when the beta is there, typically the whole sector may do well. But in order to create alpha, we believe we need to own the bottlenecks directly. And these are the bottlenecks that I mentioned.
On thermal, I mean, while your point is well understood that there are certain constraints to ramp up on renewable, but this focus on thermal again, is it a short-term thing? I mean, for next 2-3 quarters? Or is it the next 2-3 years that we're talking, that the focus will remain on thermal and therefore you're looking at ways of playing that, coal, etc.?
Yeah, look, this is a 5 to 10 year view. Look, there is a discovery of thermal as an important part of India's energy mix still. If our power demand is growing 7% per year and renewable is intermittent in nature, and we don't have a lot of batteries manufacturing locally, I think thermal will still play an important role in India's overall energy mix and the power mix, because we have to balance both the decarbonization, the environment, but at the same time, the growth that I talked about, the structural rise in the power and energy demand growth in India. We have noticed clearly government did triple out the thermal coal plant addition target about 18 to 24 months ago. And they're looking at about 88 to 90 gigawatt of thermal coal plant addition by FY32. If we assume that comes as per plan with a couple of years of execution, timeline. In addition, we're still seeing about 9%, up to 9% energy deficit in the country by FY35 for certain weeks during FY35. Now, this is not just the non-solar hours evening deficit we're saying, we're talking about the energy deficit. So we need some more reliable round-the-clock solution beyond renewable. Now, what are the options we have? Beyond coal, we've got nuclear. Yes, that'll be an important solution, but nuclear takes longer than coal. So that's a 10-year and onward story, which will be an important part of the mix. But we have a problem heading into the next 5 or 10 years from our energy deficit perspective. We have another option is the gas-fired power plant, but the gas is the most expensive solution on the power cost curve in India. So again, India isn't really at this point building more gas-fired power plants. The third option is hydro. Again, we are going hydro aggressive, which is makes sense, but hydro plants also takes longer than thermal coal. So again, from the reliable round-the-clock solution beyond renewable, the thermal coal still is an important option for the India's power mix in order to meet this 7.2% CAGR in the power demand growth for the next 10 years.
Got that, Nikhil. Good conversation. Thank you very much for joining us, and really provides us with, a framework in terms of how to think about the plays around the growth and power demand through various angles. Thanks very much once again. As Nikhil Bhandari of Goldman Sachs with some perspective there. 240 points on the Nifty, 25,200, still holding very, very nicely. Mitesh is back with us with what he'd want you to do with specific trades. Mitesh, what do you have?
Yeah. So there's some good traction in auto stocks, and Ashok Leyland has just got into a positive setup. So buy here with a stop at about 237 for targets of around 250 to begin with, and then we'll look at higher levels. The other stock which I like, that's Bank of Baroda with a buy with a stop at about 235 for targets of 247.
Okay. All right, Mitesh, got that. Thank you very much. We will take a very quick break on that note. Come back on the other side. We'll have Manisha joining in with the latest update on the commodity world. Welcome back. So the equity markets are having a good morning. Still 230 points up on the Nifty. And that's actually thanks to the commodity markets, because that collapse in oil prices, that has made the equity bulls quite happy today. So let's go back to Manisha. Manisha, what's the latest?
You know what, Surabhi, yesterday, same time, we were talking about on how the crude prices surged 5%. We're talking about almost an 11% of a decline if you count yesterday and the kind of declines that we are looking at today as well. So overnight, we've seen 8% of a cut coming in. Asia's open 4% on the lower side. We seem to be gaining a bit of that ground there. But in the last 1 month, now we're just about 9% on the higher side. And for 2025, overnight, we've turned negative for this year. We were trading up by nearly 8% yesterday when I was talking to you, and we're down by 7%. So all of that clearly has changed very, very quickly. Clearly, as we've been talking about, we are trading now at around 2-week lows when it comes for the crude oil prices. It's back at the levels before that Iran-Israel war began. Clearly, Trump announcing ceasefire agreement and the kind of statements after that we've seen from Iran and Israel coming in also seem to have taken off that premium that crude prices was holding for some time now. And then Iran's retaliatory strike that we saw in Qatar also not leading to any casualties and not too much of damage as well is what gave us sigh of relief. The oil prices also clearly have avoided that worst case scenario of Strait of Hormuz closure as well. And that was a premium that was building in for prices. Trump's statement telling everybody to keep an eye on crude oil prices, ensuring that it does not keep up. Everyone keep oil prices down. I'm watching is the statement or is the tweet that Trump put out yesterday seems to be working at this point in time. I also want to put out on what brokerages have been saying in case there was a de-escalation. Remember, we heard all of those statements from Bank of America to Citi to Mizo saying that the prices can go to 95, 120 as well if there is a worst-case scenario of Strait of Hormuz closing. But now we're talking about all of these groups talking about, now that you're talking about de-escalation, you could be looking at the crude prices coming off as well. So Mizo says that de-escalation can bring the prices down to 65. There are similar statements coming in from Bank of America, while they talk about 75 as an average for this year, which is where we already are. But they also talk about a range of anywhere between $60 to $80 until 2030 as well. Cities talked about 55 if we do not see Iran, if we do not see this escalation, and if there actually is an agreement between US and Iran, then the prices can come off quite sharply. 55, 50 are the kind of levels Cities spoken about, Bank of America has said, and Goldman Sachs talked about that as well. But moving forward from here, there's just so much to watch out for. To begin with, the Fed's rate cut plan for the month of July. We've seen a lot of statements come in from the Fed officials to this. And then you also have the 9th of July tariff deadline. It is going to be about the big, beautiful US tax bill passage as well. And then the street will absolutely watch out for the Jerome Powell's testimony for Congress today. Further cues would be coming in from this one.
Okay, all right. Thanks a lot for that quick update, Manisha. But let's get back to a couple of stocks that are moving around. And Vinny joins us to tell us about KPIT Technologies that's under some pressure. Vinny?
Hi, so yes, we have KPIT Tech that's in focus today. Why? Because they came out with their mid-quarter update. Now, when you look at this update, they're talking about the business environment being weak. There's uncertainty globally in terms of geopolitical tensions, overall tariff scenario. So that turns out to be a concern for the company. Deal pipeline. They're seeing strong deal pipelines, but the conversion of these deals, that's at a slower pace than expected. Demand trends in Europe is good, but US and Asia, that's where they're facing a bit of a problem. Ramp-ups for the wins that are progressing well, but that is also going at a slower pace. So most of the things are happening, but at a very slow pace. Now, they do not expect any one-time gains also supporting the profitability in Q1 FY26 versus Q4 FY25. So yes, a bit of an impact in terms of profitability over there. Forex also, the rates have seen a sharp change coming in. So that is also something that of an impact that we could see coming in Q1 FY26. Now, on the back of this, we have Kotak Institutional Equities that's written a note as well. They've given a sell rating target price of 1,000 rupees per share. They've cut the FY26 to FY28 earnings by 3 to 4%. JP Morgan has also written a note. Overweight rating is what they're maintaining, and target price is 1,500 rupees per share. They believe that Q1 could actually be a quarter of decline for the company, and then a bounce back maybe is something we could watch out for in Q2 FY26. They've cut the organic growth by 4% for FY26 and also cut the FY26 to FY28 CAGR growth from 16.5% to 14.5%. So yes, a bit of a pressure is what we're expecting to see in Q1 FY26, and that's why the stock is falling in trade today.
Okay, all right, Vinny, got it. Thanks very much. Explains that 5% drop on KPIT Tech today. We'll take a break, come back on the other side, and then we put the spotlight on something rather interesting, the rise of a global short drama market. We have Karan Taurani joining in. What is the short drama market? We're talking getting your attention in 90 seconds, literally. And what kind of disruption perhaps could it bring for incumbent media companies? Raj Nayak and Karan Taurani join in on this discussion. Welcome back. Well, time for some drama. And we're talking literally, actually, because we're putting the spotlight on the rise of the global short drama market. Now, what is a micro drama or a short drama? These are very, very short, bite-sized video stories which seem to be rapidly gaining attention of viewers, and they're garnering thousands and thousands of viewers. Investors are making a beeline for the segment as well. And by some estimates, the global short drama market has moved from being about a $6.5 billion market to over $7.2 billion. And of course, the numbers are still growing. This market is expected to double by 2030. Now, why are we talking about this? Because some of the Indian companies, for instance, listed Z Entertainment, decided to enter this market with a small buyout. I think the startup is called Bullet, and they have decided to partner with it. So we have Karan Taurani, Executive Vice President at Elara Capital, as well as Raj Nayak, Founder and Managing Director at House of Cheer Networks, to help us make sense of this. Gentlemen, I'll start with an admission. I have never seen a micro drama. The reason I started looking at it is once we heard that Z is getting into this segment. So let's start with the broad thought here. Karan, I mean, is this a passing fad we're talking about, or is this becoming serious business?
Hi, Survi. Good morning. I think if you look at the content creation ecosystem, we have always seen innovation in some or the other manner historically in the last 20 years. We started off, with social media. We went on to YouTube. Then we went on to Reels, which was by social media. Then OTT content, web series content, binge watch, and now we are to this, kind of content which is micro drama. So I think it's much needed. Innovation on content is a good thing, and it's much needed. Second thing is that you have to look at the audience base. I think India as a market is quite favorable. We have got more than 400 million Gen Z users. Now, this user base demographic basically is open to trying out new things. And if you look at the acceptance, I think currently there is some bit of acceptance for the global micro dramas today in a market like India in the urban markets. How this scales up in terms of the non-metro markets, how the consumer base grows, that's something to be watched out for. But definitely innovation is needed, and Gen Z is willing to try this kind of thing.
No, absolutely. I mean, no denying that. There's no disagreement on that at all. But do you have any early numbers, Karan, in terms of how big is the size? I mean, if you look at overall OTT market in India, I don't know, I mean, micro drama would be what, 1% of it, 2-3%? Do you see it gaining serious potential?
Yes, so I think if you look at the India OTT market, we are SWOT market and AWOT market put together. We're at about $3 to $3.5 billion. And a large portion of this market is dominated by YouTube. YouTube has been the major aggregator. Now, the problem here is that if you look at these OTT platforms by broadcast OTT platforms, like, for example, Hotstar, the likes of Z5, the likes of Sony Live, these have been very small in terms of revenue contribution. They haven't been able to scale up beyond a point. And the problem for this is because large part of their consumption in the OTT platform would come from catch-up TV content. So it's need of the hour to innovate for this kind of content. Obviously, in terms of numbers, I won't have numbers in terms of how big this microdrama market would be because very small as of now. But yes, definitely, if these guys are able to execute well in terms of quality of content, if there is acceptance from the consumers, they can give a tough fight to someone like YouTube as well.
Okay, all right, got that, Karan. Well, let's get Raj into the discussion as well. Hi, Raj, it's been a while since we spoke. I enjoyed your review you put out on Sitare Zameen Par over the weekend. So that was pretty good. I backed that as well. But that discussion for another time. You've seen everything, right? From the traditional daily programming to the rise of OTT. Will microdramas disrupt or coexist with the long-form OTT content in India? What are your thoughts?
I think it will coexist. I mean, disruption, everybody said when TV came and OTT came, TV is going to die. When radio came, people sang the same song. But the fact is, I think it will coexist. But what is important now is, just look at yourself. The amount of time you spend on your phone, right, is more than what you spend on television. People are consuming news on their phone today. And TikTok or Instagram is a great example of the number of hours people spend on scrolling for content. So microdramas, in a way, if it's done well, like some of the companies in China have done very well, as long as every minute or 2 minutes, whatever the content is, as long as there's a cliffhanger at the end of every episode, and it's seen more as a viral video rather than just a X episode, I think it can go on, and I think it will catch on because I look at people in Bombay sitting on trains. They will just keep consuming content, and content consumption is going to happen. We are a country with, I think, Karan just gave some numbers. Gen Z itself is about 200 plus million or whatever it is, and there are more than 900 million handphones in this country. So I think it is here. It will grow. It's like in the FMCG business, what came as sachet. People started selling sachet shampoos. I think that's a similar kind of concept here. And monetization will be easier, in my opinion. It will be faster because you can price it as low as, say, 25 paise per episode, that kind of a thing. The payment gateway is going to be a challenge. As long as they fix that, I think content generation is not going to be such a big problem because most of the content it's a challenge in a way, but most of the content that's done at the moment, even in China, is based on AI. Okay, but but that over a period of time won't give you original content. That's a challenge that we will have. But if you can fix that, if you can address that, I think it's a huge market, very big market.
Wow, and we've come such a long way. Imagine The average time duration of a song in a Hindi movie would be, what, at least 2-3 minutes? From that time, we've come to this discussion of micro drama. So content is really changing. But gentlemen, let me ask you again, just to press that point on monetization, if we have any kind of proven track record or even some instances that we can draw from globally, whether this format is working business-wise in terms of generating slightly meaningful revenue. Raj, any ideas here?
I don't have exact numbers, but what I know is, look at it this way, right? When we did advertising, in a 30-second commercial, you told a story. Now visualize, in a 2-minute, you'll be able to tell a much better story. That's the way to look at it. And monetization, I think, will happen. It's easier to monetize only because your ticket price can be so small, because your content creation is going to be extremely cheap, because you're not going to do 5 or 10 episodes. You're going to do 100, 200 or 300 episodes. All you need is a one set and good story with a good plot, and every day you can shoot, in a matter of 15 days, you can shoot all the 100 episodes, and that's it. And then you just keep releasing them every day.
Interesting, Raj. So you have answered a few of our queries there. They can coexist, could be monetized, and pricing is going to be interesting as well. And we have a big Gen Z population as well. But before we wind down in the conversation, Karan, let me come across to you. How do you think platforms might approach monetization? What are your thoughts? Do you think it's going to be ad-driven, subscription-based, or do you think it'll be via branded content?
I think for a market like India, we will initially move the AWOD way, for this kind of content. We have clearly seen in the past as well, the way YouTube has scaled up. They obviously are large because of the AWOD. If you look at the content which is behind the paywall, is largely the premium nature of content. Now, this kind of content, probably is very low cost in nature. That's the good part. ROI in this content could be extremely attractive. So I think initial inroads will be via AWOD. Globally, there are more concepts and more models where this content is also seen as scale in terms of SWOT basis. Last but not the least, I think all these platforms need to get a very good technology over here, because a lot of your monetization through advertising will happen via AI. So they need to have a really sound technology-based system to really monetize this kind of content and build upon that.
Just clarifying, this medium has its own language. When you say AWOD and SWOD, it's basically an advertising-based model versus a subscription-based model, right, Karan?
Yes, absolutely. So initially, the scale will happen on advertising-based model.
On the advertising side. Got that. Thank you very much. Very, very interesting subject. And I think we'll probably have more conversations in this as the market evolves. So thanks very much for those interesting thoughts. Well, with that, we're completely out of time. So we're going to wrap up this edition of Bazaar. Thank you very much for being with us. Markets are in steady form. Chartbusters takes the action forward.